Gold didn't climb to $3,000. It snapped through it. No pause, no pullback, no warning. While headlines called it a rally, central banks were doing something far more disturbing. They were abandoning their own paper, quietly, systematically, and replacing it with metal. When the institutions that print money stop trusting money, you have to ask, what do they see that you don't? Because this move wasn't emotional, it was mechanical, and once it started, it couldn't be stopped. And what happens next won't be decided by investors. It will be decided by the system itself. Welcome to Boring Currency Index. If you've lived long enough to remember when money actually meant something, do us a favor. Subscribe, the way you'd secure a seat before the doors quietly close. And tell us below, what corner of the world are you watching from today? When gold crossed $3,000 per ounce, it was not treated as a crisis. There were no emergency press conferences, no urgent alerts on the evening news. To most observers, it looked like just another strong market move. But to those watching closely, it was something far more serious. They understood that prices do not move like this without reason. For decades, gold had risen and fallen within predictable ranges. It respected resistance levels, it paused, it corrected. But this time it did none of that. When gold broke past $3,000, it did not slow down, it accelerated. The move was sharp, vertical, and decisive. This was not how speculative bubbles behaved. This was how systems under pressure reprice reality. Since 1971, the financial world has run on a single idea: trust in paper money. That trust weathered wars, recessions, and crises, but trust isn't permanent. It erodes silently, then shatters all at once. Lately, something has changed. Huge, consistent purchases of gold are happening. This isn't your average investor. These are the big players, central banks and massive financial institutions. They don't chase trends. They plan decades ahead. And when they move together, they reshape markets. At the same time, traders are demanding physical gold instead of paper contracts. They don't want promises anymore. They want the metal. This is straining a system built on leverage. Banks that sold gold they didn't have are scrambling to buy it back, pushing prices higher. To experts, this isn't about getting rich. It's about managing risk. Gold hitting new highs isn't a statement about wealth. It's a statement about a loss of faith in the old system. The game has changed. Thanks for watching. Did you see gold prices shoot up and wonder why? It wasn't because of what you read in the headlines. The real story started long before, in places most of us never see. It wasn't public speculation. It was a quiet, massive shift by the world's biggest financial institutions. Back in 2019, a major rule change called Basel III happened. It sounded boring, but it was a game changer. Suddenly, physical gold was reclassified as a top-tier, ultra-safe asset, just like cash. Paper gold, like ETFs and futures, didn't make the cut. This forced banks to make a choice: hold risky paper or secure the real metal. They chose the metal. Commercial banks started buying physical gold not for profit, but for security. At the same time, central banks began buying gold at a record pace. The very people who print money were trading it for solid gold. What does that tell you? Thanks for watching, and don't forget to subscribe for more insights. For decades, the global financial system relied on a simple belief. Government bonds were safe, cash was stable, risk could be managed by diversification. This belief shaped portfolios, pensions, and national reserves. But beneath the surface, the foundation was weakening. After repeated financial crises, central banks turned to the same solution every time: create more money. Balance sheets expanded. Interest rates were pushed lower. Eventually, they fell below zero in real terms. Saving no longer protected wealth. It slowly erased it. This created a problem no policymaker could publicly admit. If holding cash guaranteed loss, and lending to governments through bonds also guaranteed loss, then the definition of safe no longer applied. The tools designed to preserve capital were doing the opposite. Institutional investors saw the numbers before anyone else. Pension funds, insurance companies, and sovereign wealth funds manage obligations that stretch decades into the future. They could not afford to ignore long-term damage. Their models showed that inflation-adjusted returns were turning negative across traditional assets. Debt made the situation worse. Government borrowing had reached levels once associated with war. Repayment through growth was mathematically unrealistic. Default was politically unacceptable. That left only one path: currency dilution. The value of money would be reduced quietly over time. Markets began to price this reality. Bond yields rose, but not enough to compensate for inflation. Stock markets became unstable, moving more on policy expectations than economic strength. Traditional diversification stopped working when every asset depended on the same monetary support. Gold stood apart. It had no yield, no promise, and no counterparty. Its value did not rely on policy credibility or political discipline. It existed outside the system that was being stretched to its limits. This is why gold's rise did not follow panic. It followed logic. As confidence in financial promises weakened, capital moved toward something that required none. Gold did not compete with stocks or bonds. It replaced the role they failed to fulfill, preserving purchasing power. The move toward $3,000 reflected this shift. It was not a rejection of growth. It was a rejection of illusion. And once that rejection begins, it rarely stops at comfortable levels. When gold hit $3,000, the toughest question wasn't about economics, it was psychological. For years, investors were taught to buy the dip and avoid all-time highs, trusting the market to correct. This logic works in stable systems, but what if stability is no longer given? Institutions figured this out first. They stopped asking if gold was expensive and started asking if their currency was fragile. Price became less important than protection. Risk was no longer about market swings, but about being exposed to a system under strain. Think about it. Gold mining is getting slower and more expensive. New discoveries are rare. Meanwhile, central banks aren't buying gold to trade. They're buying it to hold, permanently tightening supply. So waiting for a big price drop assumes a reality that no longer exists. Gold at $3,000 wasn't a peak, it was a revaluation, a sign of declining faith in paper money. The real question isn't how high gold will go, but how much protection is enough.